Hey there, welcome back. If this is your first time tuning in, let me give you a quick intro. This podcast is all about two things that have made a big difference in my life: personal finance and practical money management, and real-world investment lessons I've learned over the years through both wins and mistakes in the market. I started this show not because I have all the answers, but because I've been through a lot: financial struggles, career changes, big risks, and slow wins, and I want to share what actually worked for me, in the hope that it'll help someone else avoid the common traps and build a more stable, free, and intentional life. If that sounds like something you're interested in, make sure to subscribe to the channel, and don't forget to hit the notification bell so you won't miss any future episodes. Every time a new one drops, you'll be the first to know. Thanks for being here, and let's get into today's topic. Today, we're diving into part 5 of the financial freedom journey. In the previous episode, we talked about how to build a strong foundation for managing your personal finances, starting with tracking your spending, identifying and eliminating toxic debt, and then optimizing your cash flows so that you're no longer living paycheck to paycheck. We also discussed building up your emergency fund, which acts as a financial buffer when life throws unexpected curveballs. Once that's in place, we moved on to setting up a sinking fund for planned but irregular expenses, like annual insurance payments, or a vacation you want to pay for in cash. And after building that stable base, we talked about preparing for the next big step: investing, the part where your money starts working for you. So if you haven't checked out that previous episode yet, I strongly recommend going back and listening to it. It's honestly one of the most important parts of this whole journey, because without that foundation, investing can actually become risky and unstable. Underscore 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 underscore. Now let's talk about the real topic of today's episode: how to start investing the right way, intentionally, strategically, and based on your personal goals. See, here's the thing. A lot of people think investing starts with picking stocks or jumping into crypto or buying whatever's trending on Reddit. But that's not investing. That's gambling. Real investing doesn't start with what you invest in. It starts with why you're investing in the first place. Ask yourself, what are my financial goals? How much time do I have to reach them? How much risk am I truly comfortable with? Do I want to manage my investments myself, or do I prefer automation? In this episode, I'll walk you through key concepts like expected returns, risk tolerance, asset allocation, and why diversification is not just a buzzword, it's what helps you stay in the game long term. I'll also share some of the real-life investment strategies I've used over the years, things like index funds, REITs. This won't be a textbook lesson. I'm going to talk to you like a friend who's been through it. I'll share what worked, what didn't, and what I'd do differently if I had to start all over again. So if you're feeling overwhelmed or unsure about where to begin, don't worry. I've got you. We're going to break it all down, step by step, in a way that's practical, relatable, and most importantly, doable. Grab a notebook, or just take a deep breath and listen in. Because this step, learning to invest intentionally, is where you stop trading your time for money and start building true financial freedom. Alright, let's jump into the core of today's episode. Now that you've started to accumulate some investment capital, maybe it's a few $1,000s, maybe more, the next question naturally becomes, where should I invest it? Today, I'm going to walk you through some of the most basic, beginner-friendly investment methods. And let me be clear. This episode isn't meant to be a comprehensive guide to every investment strategy under the sun. There are tons of ways to grow your money: real estate, small businesses, angel investing, options trading, you name it. But we're not going there just yet. My goal today is to help you get familiar with a few solid starting points. These are investment methods that are approachable, lower risk, and designed to help you build confidence as you grow your experience. As you continue down this path and start learning more, you'll naturally develop your own style, your own preferences, and maybe even your own creative approaches to investing. But first, let's start with something important. The number one principle I've learned from years of investing. The lower the risk, the lower the return. The higher the risk, the higher the potential return. This rule holds true probably 99% of the time. Now, sure, every once in a while, someone finds a low risk, high return opportunity. But those are unicorns. They're extremely rare, and often, when something sounds like low risk and high reward, it's probably not as safe as it seems. So where do we start? Let's begin with the most basic and lowest risk investment method out there, a savings account. Now I know, some of you might be thinking, that's not really investing. But hear me out. Putting your money into a high-yield savings account, especially with a well-established, reputable bank, is a great first step. It's virtually risk-free. Your principal is protected, and if you're in the US, your money is insured by the FDIC up to $250,000. The downside? The returns are modest, usually somewhere between 4% and 5% annual interest in a high-yield account as of now. But it's a place where your money can earn something while staying 100% liquid and safe. This is perfect for your emergency fund, short-term savings goals, like a vacation or car purchase, or just holding your investment capital while you plan your next move. The key here isn't the return. It's about building the habit of letting your money work, even in a small way. Because from here, you're going to start stepping into more strategic options, like index funds, bonds, and eventually stocks or real estate. And don't worry, we're going to walk through each of those in the upcoming sections. Step by step. No jargon. No hype. Just real, honest advice from someone who's been there. And because the risk is low, naturally, the returns are also not very high. For example, before recording this episode, I looked up the current savings account interest rates at several US banks. Most of them were offering somewhere between 4% to 6% annually. Now, I want you to pay close attention to that number, because not only is it a basic investment option, it also serves as a benchmark to help you evaluate other investment opportunities later on. Let me give you a simple example. Say you start a small business, work really hard all year, and in the end, you make a 10% profit. That might sound okay, but think about this. If you had simply put that money into a savings account, you could have earned 5 to 6% without any stress. So the question becomes, was all that extra work and risk really worth the small increase in return? This is why I always tell people, don't just look at potential profit. Always compare it to the risk-free rate of return, like what you get from a savings account. And while we're on the topic, there's another rate I encourage you to watch, the business loan interest rate. In other words, the interest rate banks are charging businesses to borrow money. Right now, in 2025, that number is hovering around 7% to 9% per year. Why does this matter? Because I've seen way too many investment pitches that promise 15%, 20%, even 30% annual returns. Sounds exciting, right? But when you hear something like that, you've got to ask a very simple question. If their project is so profitable, why don't they just borrow from a bank at 8% interest? Why are they coming to you, an individual investor, instead? And if you can't find a clear and logical answer, then I strongly recommend walking away. I'm not saying all high-return investments are scams, but based on years of experience in finance, I can tell you. If it sounds too good to be true, 90% of the time, it is. Just remember, high returns usually come with high risk. There's no free lunch in investing. Next up is the stock market. This is actually the biggest part of my portfolio, and it's also where I've spent the most time and energy over the years. Just a quick note before we dive in. All of my stock investments are in the US and Australian markets. That's the context I'll be speaking from. I hope the examples and perspectives I share can help you explore further and apply them to your own situation. Now, investing in the stock market is a massive topic. If I tried to cover everything I've learned, I could probably make 20 more episodes and still only scratch the surface. And that's just based on what I know, which of course isn't everything. So instead of diving deep into every technical detail, I want to focus on how I personally think about investing in the stock market. Let me also be clear, these are just my own opinions and investment philosophies. They might not align with what others believe, and that's totally okay. But I've been fortunate to connect with many experienced investors around the world, and in my conversations with them, I've found that a lot of them actually share similar views to mine. So here's my approach. Whenever I invest in a company, I treat it like an actual investment, not a stock trade. I'm not buying a ticker to flip next week. I'm becoming a part owner of a business. I think of it as investing, not trading. Let me walk you through a few basic steps I usually take before I decide to invest in a company. This isn't the full checklist. There are many more layers in practice. But these are the foundational things I always do. The first thing I do is dive into the numbers. Since public companies are required to publish financial statements regularly, I'll go through their reports and analyze the core health of the business. Are they profitable? Do they carry good or bad debt? What do their assets and liabilities look like? How are they depreciating long-term assets? All of that gives me a starting point for understanding the company. Then I move on to look at the market they're in and their growth strategy. I ask myself, with their current operations and their future plans, does this company have real potential? If the answer is yes, I go on to the next question: is it fairly valued? Because even if a company is great, if you buy it at the wrong time, when it's way overpriced, your returns might not be so great. So valuation is key. That's where I'll look at not just PE ratios or EPS, but also the broader picture, their competition, their market potential, and more. Once I'm confident about the company's potential and its valuation, I turn my focus to something that many investors overlook: the leadership team. This part is both rational and intuitive. There have been times when I walked away from a company simply because I didn't trust its leadership. And other times, I've invested in companies that weren't perfect on paper, just because I had strong conviction in the people running it. In fact, some of the highest returns in my portfolio have come from those decisions. So as you can probably tell by now, I don't treat investing like a quick trade. I treat it like backing a business I believe in. Imagine if your friend ran a company, and you followed it closely for years. They regularly sent you updates about how it's doing, and over time, you could see the company growing stronger. You believe in your friend, and you trust their leadership, so you decide to invest. That's the kind of relationship I aim to have with the businesses I put my money into. Because of that mindset, I don't hold hundreds of companies in my portfolio. My portfolio is relatively small, and I'm totally fine with that. I know this goes against the usual advice about diversification, and just to clarify, I'm not saying diversification is bad. In fact, for some parts of my portfolio, I do diversify quite a lot. But when it comes to the companies I invest in directly, I go deep, not wide. I set very high standards, and very few companies actually meet them. Now, for those of you who are new or simply don't have the time or desire to dive deep into financial reports, I get it. It's a lot of work. And the good news is, there are simpler, safer ways to invest in the stock market. One of the best options, especially for beginners, is to invest in index funds or ETFs. These are funds that track a whole basket of companies, like the S&P 500. Instead of trying to buy 500 individual stocks, you can just buy one ETF that mirrors the entire index. It's simple, it's diversified, and historically it's delivered solid long-term returns, even outperforming many hedge funds. Warren Buffett even made a famous $1 million bet that a simple S&P 500 index fund would beat a group of hedge funds over 10 years, and he won. So if you're not the kind of person who wants to spend hours researching companies, ETFs and index funds are an excellent way to invest wisely without all the stress. I usually don't tell people exactly what to buy, but if there's one general piece of advice I feel comfortable giving, it's this: start with index funds. Then, once you're more confident and experienced, you can explore individual stocks, if you want to. As for me, I divide my capital into different buckets based on my goals. The money I want to keep safe and growing slowly goes into ETFs. The money I'm willing to take more risk with, in exchange for higher potential returns, goes into carefully selected individual stocks. And a small portion goes into high-risk ventures that I treat like long-shot bets. At the end of the day, it's all about knowing yourself, your risk tolerance, and managing your money in a way that makes sense for you. There's still so much more I could talk about when it comes to the stock market, but I'll stop here for now. Maybe in a future episode, I'll go deeper into some of the other topics we didn't get to today. Apart from the stock market, there's another investment channel that I really enjoy, which is investing directly in businesses. This could involve partnering with friends to start a company in a particular field, or sometimes it could be something simpler like opening a clothing store or a coffee shop. In my case, since I work in the tech industry, most of the companies I invest in are tech companies. In many cases, these are also companies I advise on. After spending time working with and understanding the potential of these companies, I decided to invest in them. First, because I understand the field well, I can make more accurate assessments of these companies. Second, I can also get involved in some of the operational activities and help these companies grow. Of course, these types of investments carry more risk, but I consider them to be a form of high-risk, high-reward investing. And I believe you can do the same. Your field may not be technology, but everyone has their own expertise. From that expertise, you can make your own judgments when you come across a promising investment opportunity. The key point here is that when you invest directly in a business, you're not just a passive investor, you can become an active part of the company, contributing to its strategic decisions and helping it grow. It's a very interesting and challenging form of investment, but if you have the experience and patience, the rewards can be very attractive. Through these points, I've given you a basic overview of some investment channels. From these initial insights, you can further research and choose the right investment channels for yourself. Additionally, alongside these investments, you should continue to look for new sources of income. This could be active income, or ideally, passive income. Passive income here means income that flows into your wallet without you having to actively work for it. For example, when you invest in the stock market, besides the potential increase in stock prices, depending on the business performance, these companies may periodically share profits with shareholders through a process called dividends. The income from dividends is a form of passive income. Another example is if you rent out a property, like a house. If you have a house and decide to rent it out, the monthly income you get from that rental is a form of passive income. Similarly, if you own a car that you don't use, and you rent it out, that is also considered passive income. I'm sure you can come up with many other passive income sources. For me, passive income is very important because, unlike active income, where we trade our time and effort for money, both of which are limited, passive income is not dependent on those two factors. Therefore, the amount of passive income we can generate is unlimited. The more passive income streams we have, the more money flows in, and from there, we can reinvest in the investment activities I mentioned earlier. These activities will continue to generate more money for us. Once we have more money, we can go on to establish even more passive income sources. And this process keeps repeating itself. That's why I often say we use money to make more money for ourselves. The more we do this, the faster our money machine will work. Eventually, this will lead us toward financial freedom. As for the specific milestones of financial freedom, I'll be discussing that in upcoming episodes, which will also be the final episodes of this series. I will stop here. I hope that through the sharing in this episode, you have gained new interests in investment activities. In these stages, not only will your financial life become more secure, but these investment activities will also bring financial returns. Moreover, I believe this process will bring a lot of joy as well. That is why I hope that through this episode, I have been able to inspire you a little more on your journey toward financial freedom. If you find the content I shared useful, please feel free to share it with your friends. Thank you, and I look forward to seeing you in the next episodes.